So for all my new people, you'll hear people say, when you buy ETF or you buy index fund, you have a small piece of that company. That's a lie. You don't have no ownership in that company when you buy ETF or an index fund. What you're doing is you're investing in a fund, and you're basing your returns are based on how the fund performs. You have no ownership of the companies inside the fund. The fund does. All right, man, listen, for all my people that's new to the game and you don't want to take as much risk with individual stocks, today I'm gonna give you 2 ETFs that you should own as a beginner in this game. Now, first let me explain what ETF sells. So ETF is an exchange traded fund. It is a group of stocks that are similar in products and service or performance-wise, right? So it can be a group of stocks that may be growth. It may be a group of stocks that may be dividend. It may be a group of stocks that have similar products and services. What happens is there's a fund. A fund is think about a group of people with a big bag, with a management team with a check, and they are responsible for putting stocks together that can give you a great return. And the goal behind that is to help you as an individual investor really not have to worry about picking stocks no more. Well, you got to pay them what's called an expense ratio. So you'll pay them to do that for you. Now, their job is to actively manage that fund. So they're going to find stocks that are working, stocks that are not working. They're going to move in and out. This is specifically what they do. So today, I'm going to give you 2 stocks, 2 ETFs that I think beginners should own. Outside of the ones they talk about all the time, like those are the basic ones. I like to pull the hood up and I like to really dig in, right? So before we get into this, man, make sure you like this video, make sure you subscribe to it, man, share it. But most importantly, real talk, I want you to comment below in the chat and let us know if you're feeling what we putting down. But also, tell us how we can help you, because that's our goal. Our goal is not to just tell you, hey, invest in this, invest in that. These stocks are gonna do this, these stocks are gonna do that. Our goal is purely an education channel, right? We want to educate you for the free, right? All we asking you for is your most expensive asset, your time, right? I don't wanna waste my time, I don't wanna waste your time, but I actually wanna help you buy back your time. And we do that by making great investments. So, the first ETF on our list, watch this, y'all, is ticker symbol IWF. That's right, IWF. It is the iShares Russell 1000 Growth ETF. Now, if you're a beginner in the game, why would I put you here? Well, because I want you to focus on growth. Now, if you know me, if you're new to me, I love to be on edge. I love to push my people. I want to break my people out of the crazy, mundane, boring ideas that have been passed down from generation to generation. I don't agree with everything Warren Buffett said. I don't agree with everything that Charlie Munger said. So I'm gonna probably always get flack behind that. You know, one of the things that Buffett said is investing in the stock market should be like watching paint dry. Well, I don't look at it like that, because every time I make an investment, I'm growing my wealth. So I want to watch it. I'm excited by picking great companies. I'm excited by, you know, when the market pulls back. I'm excited when the market runs up. Like, I keep that energy. So I don't agree with that. I also don't agree that all investors should just buy index funds and get 8%. Why would I get 8% and settle with 8% or 10% when they got companies that's doing 10% in a quarter, 8% in a day? You know what I'm saying? So I think that this ain't your granddaddy's stock market. That's why we say Wall Street looks like us now, because we excited about buying companies. We excited about stocks. We don't panic when stocks go down. We're not trying to own 800,000 stocks. So for me, it's putting us in that comfort zone so that we can play this game at a high level and win this game. So with that being said, IWF is the iShares. So the iShares is owned by the biggest asset manager, which is BlackRock, right? So they make the most ETFs. So if you go look at who owns the most, it's going to be BlackRock, and then it's going to be Vanguard. Those 2 are the big dogs. Number 3 going to be State Street. So those are the big 3. I actually need to make a video on who runs the world. The president? Nope. The Republicans? Nope. The Democrats? Nope. Who runs the world? The biggest asset managers are who run America. The money run America, not the politicians, right? Because Rothschild or Rockefeller said, give me control of the money, I don't care who make the laws. You know why? Because if I got the money, I can bend the laws. I am the law if I got the money. You know what I'm talking about? So anyway, I don't want people to shut me down for saying that. All right, so this IWF is iShares. So watch this. Year to date, as of right now, we in April, this ETF is already up 10.5%. But also, let me tell you this. So for all my new people, you'll hear people say, when you buy ETF or you buy index fund, you have a small piece of that company. That's a lie. You don't have no ownership in that company when you buy ETF or an index fund. What you're doing is you're investing in a fund. And you are basing your returns are based on how the fund performs. You have no ownership of the companies inside the fund. The fund does. Now, what happens is they're spreading your money out based on how the fund has allocated its money in those positions. But you don't own those positions. You don't get voting right on those positions. And that's how you know you don't own a piece of that stock. You have zero voting rights on the pieces of stock inside the fund. Zero. Now, when you own an individual stock, you have voting rights because you become a owner. So if anybody tells you that when you own an ETF, you own a piece of a stock, tell them they're lying. And they don't know what the hell they're talking about. They regurgitate some information from somebody. You have zero ownership, but you are invested in the fund. And that's why the fund is making you pay them, because they're responsible for getting you a return on your money. So tell your financial advisor, tell your stock market guru, or whoever you're listening to, if they say you own a piece of the stock in the fund, you say, give me my money back. Trap told me that. All right, so this fund tracks large and mid-cap growth stocks. That's right, it tracks large and mid-cap growth stocks in America. So this year it has returned 10.59%. Last year it returned 42%. In 3 years it have an 8% return, but in 5 years it has a 19% return. I'm telling you, this is one that you beginners should own, right? It actually holds 440 stocks. That's why I tell y'all don't need to be owning 20 and 30 stocks. At that point, you're an index fund. You know what I'm saying? You don't want to be an index fund. You don't want to be a doggone ETF. You don't want to be that. Right? You want to be 10, 15 stocks. That's what you want to do. All right, let's go a little deep into this. So as we go a little deep into this, I want you to understand that the fund has a net value of $88 billion, just this fund alone right here, which is pretty good. And I won't get into the deeper realms of it, right? So I want to give you the top maybe 6 or 7 holders. Right, so watch this. Its number one holding is Microsoft. It has $10 billion worth of Microsoft shares. It has Microsoft makes up 11.97% of the fund. It actually has 25 million shares of Microsoft. Golly. It has 25 million shares of Microsoft. That is crazy, right? Number 2 on the list is Apple. It has $8 billion worth of Apple stock. Apple makes up 9.47% of it, and it is worth $49 billion. That's crazy too. Number 3 on their list is NVIDIA. It has $7 billion worth of NVIDIA stock. NVIDIA makes up 8.0% of the fund, and it owns 8 billion shares of NVIDIA. Next on the list, number 4, is Amazon. Amazon makes up 6.2%. It has $5 billion worth of Amazon stock. And the Amazon shares, it owns $30 billion of Amazon. So you might ask me, Trap, how can it have 30 billion shares but only own 6%? Well, Amazon makes up 6% because price also makes a difference, right? So if you think about it, it owns 49 billion shares of Apple, but Apple stock is what? 160 some dollars. And what they'll do is, this is a good learning lesson. As Apple price goes up, that position in way may go up, and they may have to sell off or reposition, because as the stock goes up, the percentage and what it makes in the fund goes up, and it wants to stay at 100%. So it doesn't want to be 110%. It doesn't want to be 115%. So what happens is, as the stock goes up, the position swells up. So now they got to move some things around. They may have to sell off some shares. This is why you get sell-offs as well. When you hear hedge funds are taking profit, what they're doing is they're rebalancing their portfolio. God, that's good teaching right there. That's good teaching right there. That's good teaching right there, right? So with that at 1, 2, 3, 4, 5. Number 5 on the list is Meta. So Meta, they have $3.7 billion worth. Meta makes up 4.29% of their portfolio, and they have 7 billion shares of Meta. And I want to go one more. Now, this one is big. So they own Google A and Google C as they 6 and 7, right? As they 6 and 7, right? Now, watch this. They have 3.1 billion. They have 2.6 billion in A and 2.2 billion in B, which probably give them a total of 6, 7, 8, almost $5 billion, right? Both positions together, one makes up 3%, one makes up 2.1%, which gives them about 5.5% in total. They own 17 billion shares of Google A and 2 billion shares of Google C. Now, as you can see, that's all technology. But their number 8 is Eli Lilly. Eli Lilly, they have $2 billion worth. It makes up 2%, and they have $2.8 billion of 2.8 billion shares. But I just want to go a little deeper and see what else they got in there. So they got Visa. Visa makes up 1% at $1 billion. MasterCard makes up 1%. Home Depot makes up 1%. AbbVie makes up 1%. I don't know why they got AbbVie in there. Costco makes up 1%. Netflix makes up 1%, which they have 911 million. Adobe is in there as well. Let's see what else they got. Intuit. Okay, that's under 1%. AMD. All right. So I'm really not mad at that, man. I'm not mad at that at all. But let's go a little further, right? When we break down the holdings, the way it's separated. So information technology makes up 43% of their holdings. Consumer discretionary makes up 14% of their holdings. Communications make up 12% of their holdings. Healthcare makes up 10% of their holdings. Financials makes up 6%. Industrials make up 6%. Real estate makes up less than 1%. Materials make up less than 1%. Energy makes up less than 0.5%. And they have less than 20%, less than 0.5% of money in cash. So that's one of the ETFs that I think you should own as a beginner. I'm a firm believer that America is a country full of people who have and will have medical issues, right? I think that America has made it easy for people to get sick. I think America has made it where they're extremely profitable off people being sick. And for that, I know for a fact that medical devices will be an industry that will just make people billionaires, right? And it's because American people just, they won't get right. They won't get right. And so I understand that. So watch this. So it is not crazy, but year to date is up 5%, but in 1 year is up 4%, in 5 years is up 10%, inception is up 12%. So I think it's going to be it's solid for you as an investor. Now the thing about this ETF seeks to track investments in the healthcare and medical device industry, right? And so this industry is where you get this is how I found out about Eli Lilly a while back. It has a total of 52 holdings, so it doesn't have a lot of holdings in it. But I think it is real interesting when we look at some of the companies that's inside of it. So one, Abbott Laboratories is in is 16%. Intuitive Surgical is 11%. Stryker makes up 10%. Medtronic makes up 5%. Edward Life Science makes up 4%. Dexcom. They just added GE Health inside of this company. I think it is one that you should own. And we go a little further, let's look at it, right? So they own $931 million worth of Abbott Laboratories, which is equivalent to about 8.3 billion shares. They own Intuitive Surgical, which is a company that I truly love. They have 651 million value. It's 11% of the portfolio. It makes up 1.6 billion shares. Stryker, these top three are big dogs in the medical industry right there. Stryker is 10% of the portfolio. It's worth 572 million with 1.6 billion shares. Medtronic, the top four is just big dogs. If you just go look them up, right? Big dogs is worth 5% of the portfolio, 281 million, 3.3 billion shares. Edward Life Science, another sleeper, 265 million, 4.7% of the portfolio, and they have 2.8 billion shares. Boston Scientific is another one. Let's see what else they have that we like. Sidebone. Oh, that's a good one. I thought about that one, right? USD, they cash, they have 1.1 billion in cash sitting on the side. I like that. That's how I found out about Eli Lilly. They was in here. I was like, okay, it's not bad. They got General Electric Health up in there. That's good. 99% of the fund is in the healthcare industry. The other, 99.8 is in the healthcare industry. The other less than 0.25% is in cash. And the reason why I think that all beginners should own this is because this allows you to have growth and allows you to be in the healthcare industry. Healthcare is a vital part of being in America, I personally feel. And again, this is just personal opinion, right? It's just personal opinion. But I feel like this would do your portfolio well. It would give you balance. And so even though growth is going to fuel America, we also know that people that are on these medical devices can't live without them. And so that's what I like. Think about like somebody that's on insulin. When can they get off insulin? When can they get off insulin? Right? I want you to think about that. Like when you got somebody like Abbott Laboratories and Intuitive Surgical, they do a lot of the robotics that the doctors need to do surgery and stuff together. Like it's a done. Stryker, one of the main devices used in a hospital, right? Edward Life Sciences, like these are things that are not just sometimes, they're always needed. They're always creating things that are necessary for this industry. And I feel like it can do you great justice in your portfolio. Now with this one, you're not gonna get hella crazy returns, but they're gonna be solid and they're gonna keep you from being in the negative. 100%, man. So I hope you enjoyed these two beginner ETFs. Let me know what you think. Another thing that you can do that I learned how to do was, I like to use ETFs as a way to get paid to learn. So what I like to do is go inside the ETF, find one or two companies that I really like, and then when I find those one or two companies that I really, really like, that I did the research on, that my emotion matched the data, I go get those companies, I go buy those companies, I own those companies for a long period of time. It's truly how I found out about Eli Lilly a long time ago. I don't know why they're not in there no more. But once I found out they was number one in the United States with insulin, I was like, oh, this is crazy. You know what I'm saying? So definitely check these out. But if you don't check these out, go find some more that you really like. I think ETFs are a great way for you to learn how to get paid while you learn it. So man, it's your boy, the Wall Street Trapper. Make sure I see you each and every Tuesday, 7 p.m. on the Wall Street Looks Like Us Now Network on YouTube, checking us out on Trapping Tuesdays, man. Make sure you like, make sure you subscribe, make sure you share this with your family and friends. Your boy, the Wall Street Trapper. Salute.